Welcome back to the Benefits Blake channel. This is part 3 of 3 on firing your benefits broker. The first video was why, how we get paid and why it works against you. The second was when, the red flags and the timing. Today is how, the actual mechanics of changing brokers. And I'll say it one more time so nobody feels like I've snuck anything past them. I'm a broker. I'm an employee benefits advisor at DSP Insurance Services. And the process I'm about to walk you through is the exact process somebody would use to hire me or to fire me. Here's what we're covering: what a broker of record letter actually is, because it's much simpler than many people think; what you need to gather before you sign anything; the claims data piece and the one document you need in place first; how the switch actually works mechanically, carrier by carrier; how to handle the human element, because when firing someone, there always is one; what the transition really looks like, which is the part everybody underestimates; and then what to demand from whoever comes next, so you don't do this again in 3 years. Let's start by taking the mystery out of it, because I think people build this up into something enormous in their head. A broker of record letter is 1 page. That's it. It's a short letter on your company letterhead that tells your insurance carrier that effective on a certain date, this new agency is your broker of record, and it replaces whoever was the one before. You sign it. Your new broker emails it to the carriers. The carriers update their records. Your old broker loses access to your accounts. New broker gains access to your accounts. That's it. It's an administrative change at the carrier. Now, I want to be really clear about what it is not, because these are 3 things I hear frequently when engaging with a new client. It's not a change to your insurance. Your plan doesn't change. Your network doesn't change. Your ID cards don't change. Your employees aren't going to notice anything happened, and they shouldn't. Number 2, it's not something you have to wait for open enrollment to do. You can do it in March. You can do it in August. You can do it in December. It doesn't matter. There is no fixed window. And third, it doesn't cost you anything. In the vast majority of cases, the commission's already baked into your premium. That money's going out the door either way. You're simply redirecting it to a new broker who you feel can add more value. You're not spending more money. Now, if you're paying a separate flat fee under a written service agreement today, or will be in the future, that's a different conversation. And you'd want to take a look at your agreement for a notice provision. But for most fully insured small to mid-market employers, the money's 100% already baked in. Before you sign anything, gather your documents. And I mean before, while you still have a cooperative relationship, because the day after that broker of record letter gets filed with the carriers, your old broker's motivation to be helpful goes to about 0. They're not being vindictive. They're just not your broker anymore. They're not getting paid this month or next, and they've got other clients. So what do you need to get together? Here's the list. Plan documents, your summary plan description, your summaries of benefits and coverage, your current benefit summaries for every other line. Most of these are available from your TPA or carriers directly, and you should probably already have all of them readily available and on file. But if you don't, they're worth tracking down before you make the switch. Additionally, you're going to need your carrier invoices. A broker change is a great opportunity, number 1, to audit your billing arrangement. But number 2, that invoice contains your account numbers, your group numbers, which are required in order to generate that broker of record letter. Next, your carrier contracts. If there's anything else out there, if you're self-funded, your stop loss policy, the full policy, not just the proposal. There's a real difference in those endorsements that your new broker needs to be aware of. Your TPA agreement, if you have one. While you're there, read the termination language and the run-out terms in both of those contracts. Most employers have never opened that document. It's the one that governs what happens when you leave your TPA. Your pharmacy benefit manager contract, if your pharmacy's carved out, 2 to 3 years of your renewal history, if you have it available. Keep in mind, when you change brokers, they're going to lose that past history on what's happened with previous carriers and what it offers looked like, what was competitive, what wasn't. So preferably not just the final rates, but 2 to 3 years of renewal history with the entire renewal packet negotiations, initial offers, broker documentation. Give them 3 years worth of data if you can, not just the current. Your last 2 or 3 Form 5500 filings, the proof that you've actually done the newer stuff like gag clause attestations, your RxDC submission, your 1095C filings. If you respond to your new broker with our old broker handled that, that's great. Can you give us some confirmation on what was filed and when so we know what to engage on, that actual confirmation from them? If you can't produce it, we've found something, and I guess that's good. It's better that we find it now than in a formal audit later. Don't forget about your compensation disclosure. We covered it in video 1. You're entitled to it. If you're self-funded or level funded as well, you need to pull your claims data. It's the single most valuable thing that you own, and most employers don't realize that you can just ask for it. Your broker's got it if they're engaged with your TPA. If not, your TPA's got it. Your carrier's got it. Someone's got that data. Go ask for it. Go find it. If you know where it's at when your new broker gets involved, excellent. If you don't, ask them. They'll help you find it. They'll go find it for you. Your large claim reports, your pharmacy utilization, all of that's helpful, especially if you're interviewing multiple brokers, so that you can share some information about your group and understand what strategies and how they might go about developing strategies and recommendations for you and for your group. If you're just giving them a census and the most current, I call it 12 months of claims data, all they're going to be able to do is generate a quote, not build a strategy for you. A broker who can only quote you is the one that you're trying to leave today. Engage with someone that can build that strategy. On the claims data side, though, this matters. This is important. Before you hand protected health information to a prospective advisor, you need a BAA, a business associate agreement, in place. It's a HIPAA requirement. It is not optional. It's also a pretty good test. If a new prospective broker engages you and requests you to provide claims data before providing you a BAA, that's a yellow flag. If you engage with a new provider and they request claims data, again, yellow flag if they haven't offered a BAA. If you ask for a BAA and they don't provide it to you, I don't want to say immediately, but same day, next day, that's also a yellow flag, maybe even a red flag if they can't get their hands on it. If somebody hems and haws about it, or they just ask you to email over the claims file real quick, that tells you what their compliance operation looks like, and you've learned it for free before you've even engaged with them. Most claims reporting you'd share for an analysis is de-identified or aggregated anyway. That can change the calculus somewhat, but get that BAA in place. It costs you nothing, and it's the right way to do it. So mechanically, how does a switch actually work? The letter is carrier specific. Not everyone expects that. It's not one letter that changes everything. If you've got medical with one carrier, dental and vision with another, life and disability somewhere else, and a COBRA vendor sitting on top of all of that, that's 4 different letters. 5 carriers means 5 letters. And that's actually useful information. It means you can move a piece of your business without being forced to move all of it. I've seen employers move their medical and leave the ancillary lines where they are for a year while they evaluate their new broker partnership. You are allowed to do that. Most carriers have their own broker of record form or their own required language or process or supplemental forms. Your new broker is responsible to handle all of that. It's their job to know each carrier's format. And I'll clue you in a little bit. If a prospective advisor doesn't know the carrier's process off the top of their head, that's probably maybe a red flag even, not just a yellow flag that they haven't engaged with that carrier, or at least not in the broker of record process recently, right? It's possible they haven't worked with that carrier or that vendor at all. So be aware of that as you get into the process. 2 small things that'll save you a do-over. The letter needs to be signed by somebody the carrier recognizes as an authorized officer of your company. So get the CEO, get the CFO's signature. If it's not one of them, it should be the plan administrator. It also needs to be on company letterhead, dated with the account number and naming the specific lines of coverage. Example, medical, dental, vision. Example, long-term disability, short-term disability, supplemental life insurance. Those need to be spelled out. If you miss any of that, the carrier might kick it back and your clock's going to start over. When it gets filed, the carrier is going to notify your existing broker. That notice usually opens a short window, and it's going to vary by carrier, where the incumbent should and can contact you to try and keep the business. It's where the letter could technically be rescinded if you change your mind. How long is that window? I don't know. It varies. And I want to be straight with you that there's really no law here. It's more just carrier best practices. Broker of record letters are not really regulated, and what little bit exists varies state to state. The general principle courts have landed on is that you ought to be free to do business with whoever you want to do business with. What the industry has instead is convention. The agent trade associations recommend that carriers wait something like 5 to 10 business days after they notify the incumbent, specifically to give that incumbent a chance to talk you out of it. Actual processing runs anywhere from 10 to 30 days, depending on the carrier and the line of coverage. There's no universal rule. Ask your carrier what theirs is, or ask your new broker to ask you about their experience with the timelines from your carrier. And yes, a broker of record letter can be rescinded. It stays in effect until it's formally rescinded in writing by an authorized officer of your company. So if your current broker calls and tries to win you back, that's a legitimate opportunity for them, and they know that. It's exactly why you should expect that call to be coming. Understand what that window means practically. Your current broker is going to find out, and they're going to call you. Plan for that call, or call them first. Decide before you file whether you're open to a counter or whether you've made your decision. Deciding in the moment on the phone with somebody you've known for years, that's how people end up staying another few years somewhere that they don't want to be. I've been telling you this is simple, and it mostly is, but there is one thing that can genuinely get in your way, and it may not show up until you're already well down the path. Captives. If you're in a group captive, your seat in that captive may be tied to them staying your broker, your incumbent staying your broker. Read your captive documents before you do anything. Reach out to your captive account manager or account executive. Exit terms, notice period, how your collateral gets released, what happens to your share of the surplus could be relevant if you really need to get away from your broker and are willing to give up the captive accordingly. Are you permitted to reassign your stop loss broker? The same thing actually can happen if your stop loss is placed through an MGU, a managing general underwriter that has an exclusive arrangement with that agency or that brokerage. You can submit the letter and then lose access to your carrier at renewal. That's not a paperwork problem. That's a coverage problem. And it's one legitimate reason to slow down in your process if you're with a captive today. All right, let's talk about the part that nobody puts in a checklist. If you've had a real relationship with this person, and a lot of you have, they've been to your holiday party, they know your HR director's kids' names, call them first before the letter gets filed. Not an email, a phone call. You don't owe them a debate. You're not asking permission, and you shouldn't frame it that way. You're telling them, and you're telling them yourself instead of letting a carrier notification do it for you. It's a 5-minute call, and it's just the decent way to do it. And I'll be honest about my own side of this. Everybody in my industry has been on the receiving end of that call. It's not fun. But the ones I respect are the employers who made it themselves, and they told me what was going on. The ones that sting are the ones that you find out from a carrier email on a Tuesday, and you go back through your notes wondering what you missed. You call the client and ask, and you're trying to get it rescinded. Obviously, they weren't advised by their new broker to make that phone call to you. Or maybe they were and they chose not to. Either way, that other broker that's getting fired is probably learning something in that process. The other reason to make this call is practical, though. You may need something from your former broker during the transition, a file, a history, context on why something got set up the way it did. Burning it down on the way out costs you some very real and probably valuable information. Now, if the relationship is genuinely adversarial, or if they've been stonewalling you on a compensation disclosure, or if there's another real problem, skip the courtesy and just get it done. Fire them, hire the new broker, and move on. You don't owe warmth to somebody who's been working against your interests. Use your best judgment. Okay, this next part is the one nobody warns you about, and it's where most transitions go sideways. A lot of what your broker gives you isn't advice. It's software that they pay for. Your name's on the account, their name's on the license. And when they go, it goes. Start with your benefits administration system, Employee Navigator, Ease, whatever you're on. Your broker is the customer there, not you. So when that letter gets filed, the account's going to walk out the door with them, meaning they're going to shut your access off. Usually your new broker can just take over the existing setup. Most of these platforms over the last couple of years have built a process exactly for this. But ask about it early with your broker. Your first meeting is when this should be discussed if you're renting, quote unquote, a platform from your broker. Because if you do need to rebuild on a new platform, the platform's not necessarily the expensive part, but setting up the carrier data feeds and the time that takes is. Every EDI connection to a new carrier is a 2 to 4 month build and test process. And a broken feed's not a paperwork problem. It's a terminated employee still on your plan 6 months later. It's a new hire with no ID card a year later. It's the most expensive surprise in a broker change, and almost nobody sees it coming. Same story exists on the analytics side. If your broker's been walking you through dashboards like Springbuck, Artemis, whatever they use, that platform may be theirs. And the valuable thing sitting in it isn't the software. It's 2 or 3 years of your claims data and the recommendations that came along with it, cleaned up and mapped in a way that's actually usable for you. That took somebody months. It's arguably their worked product, not yours. So don't spend your energy fighting over the dashboard. Go straight to your TPA and your PBM and get a data feed pointed at your new advisor directly, because that's where it all came from in the first place. Your data lives at the source. Your broker was just borrowing it. Then there's the stuff that your HR team uses every week and has no idea is coming from your broker. Maybe you do, maybe you don't. The HR hotline, the handbook builder, the state law library, your wrap document, your summary plan description generator, your section 125 plan document, your form 5500 filing, whoever's cutting your 1095Cs. A lot of the free things, some of those are free, some of those may be paid. A lot of the free and paid services, though, in your benefits program are being facilitated by your broker. You want to make a list of every vendor. Ask your HR teams to make a list of every vendor they touch. Mark which ones that they have a direct contract with and which ones they default to their broker's relationship or their broker's contract. Most employers have never asked that question once, and the answer surprises them. Now, your employee-facing material, your benefit guide is your broker's design file. You're going to get the PDF. You're probably not going to get the working file, and honestly, that's normal. It's their work product. Budget for a rebuild or know that your new broker is going to need the time to get that done. But the real issue isn't the design, it's what's printed on it. There's service team's phone number and email, maybe on your guide, your new hire packets, your intranet, the poster in the break room, the QR code by the clock, the Spanish version of all of it. Your employees may have that number saved in their phone. So before you file anything, decide who your people call on day one and tell them if it's relevant. Nobody with a claim problem should hit a deadline because you changed brokers. And the last one takes 5 minutes and it saves you a month. Go into every carrier, TPA, and PBM employer portal and make sure somebody who actually works for you is the primary administrator, not your broker. Brokers end up as a primary admin constantly, especially if you have internal turnover. And it's not sinister. It's just whoever did the setup usually on behalf of the group. But I've watched an employer get locked out of their own carrier account because the only administrator on file worked at the agency they just fired. Check on it before, not after you sign those broker of record letters. Here's where I want to reset expectations, because this is where employers get surprised. The carrier changes fast, from a few days to a couple of weeks, depending on the carrier in whatever notice window they apply. That's part mechanical, and it's basically over before you feel it. The actual handoff, though, is not quite as fast. Getting claims data feeds repointed, getting your new advisor properly credentialed with every vendor and getting them access to your account. Vendor introductions if you've got a unique TPA or PBM or stop loss carrier. A thorough document review. Getting somebody genuinely up to speed on why your plan is built the way it is. You've got a unique TPA or PBM or stop loss carrier. A thorough document review. Getting somebody genuinely up to speed on why your plan is built the way it is. That's a real project. And I'd budget 3 to 6 months for a new advisor to be fully operational on a self-funded plan. Less if you're fully insured with one carrier and a simple setup. So plan for the long version. This is exactly why I said in the last video that you move 4 to 6 months ahead of your renewal, not at it. A rush transition is how things fall through the cracks. It's how a compliance deadline gets missed in the handoff. Everybody assumed the other party was tracking it or handling it. This also brings up one more specific thing. During a transition, explicitly assign who's going to own compliance deadlines while you're transitioning. Write it down. 5500, PCORI filing, gag clause attestation, any notices that need to go out. Remember, you're an employer. Those are your obligations, and they don't pause just because you're switching advisors. It's the single most common thing I see slip in a broker change. I can't tell you how many new clients come to me and they've missed 6 months of their most recent filings because they didn't like talking to their broker recently. They were getting ready to fire them, but nobody took on the responsibility in the interim. Same rule for anything else already in motion. Write down every open item and put a name next to it. Is the broker handling it? Is it internal? Does it need to be handled to the new broker? Is a carrier on it? Every open item should have an owner. Open claim appeals, pending evidence of insurability, disability claims in review, a COBRA dispute. And if you're self-funded, specifically, any stop loss reimbursement you file, there's still need to file. Those policies have filing deadlines. If you miss it in the handoff, that's not an inconvenience. That could be a 6 or 7 figure check that you don't get. I've seen it happen, and no one was being careless. Both brokers just assumed the other one had it. 2 pieces of housekeeping while you're there. Your old broker is holding your employees' protected health information. Your business associate agreement with them requires them to return it or destroy it when the relationship ends. However, their business best practice is usually to maintain documentations for 7 years. Ask for confirmation in writing on what they're doing with your data when you terminate as a client. It's a 1-line email and it closes the loop. And then offboard them the way you'd offboard any other vendor. Distribution lists, shared mailboxes, standing calendar invites, your Teams channel, wherever your carrier invoices were routing if they were going through their office. Check with all of your vendors. Your broker, your new broker will absolutely take point on this, but flag anything for them you see that looks suspicious so you think they might be missing. Okay, so you've decided to move. Don't just move to whoever showed up with the nicest proposal. Interview 2 or 3 advisors and ask better questions than most employers ask. Ask for a written compensation disclosure before coverage is bound. Ask them how they plan to get paid by your program before you sign a broker of record letter. Ask what they actually do between renewals. This is my favorite question, and I wish more people asked it because it's where the difference between an advisor and I'll call it a broker actually lives. If the honest answer is we're here if you need us, that's a broker. You want to hear about a calendar, quarterly claim reviews, mid-year strategy, compliance tracking, something with dates on it, something actionable. Ask how they document vendor monitoring. That is your fiduciary duty. You need someone who's going to help you create that paper trail that you can point to if you ever get asked by the Department of Labor. Ask who's going to actually be in the room for meetings, not the person selling you. The service team, the advisors, the account executives, the account managers. If you are so blessed to be able to work with your salesperson as well in perpetuity, bless you. You must have a broker like you get at DSP. That's not the majority. Get the names of the people you're going to be working with. Make sure you jive with them. A lot of employers get sold by a principal of a firm and then serviced by somebody they've never met. And that's a completely different relationship than the one they were trying to buy. Ask them to show you a redacted claims review they did for a company your size. Ask them to walk you through your own renewal history and tell you what they'd have done differently. I like that last one a lot, but I think I've only been asked it once. Then see who answers these questions well, who does their homework, or who just shows up with a cost analysis in Microsoft Excel. Last thing, and this is where I think most employers actually get stuck. It's not the process. The process is one page and we just covered it. People think they need a perfect replacement fully lined up and vetted before they're allowed to start looking. They never start looking because the research feels like a project and there's always something more urgent this quarter. And then it's another renewal and then it's another one. You don't need a replacement to start. You just need to take 2 meetings. Take 2 meetings with advisors who don't currently have your business and see what they ask you about. That's it. That's the entire first step, and it commits you to nothing. Because here's what I've noticed. Employers who take those 2 meetings either come away with a new advisor or they come away with a much sharper set of questions for the one they've got that they enjoy working with. Either way, they win. There's no version of that conversation where you come out worse than when you went in. So that's the series. Why, which is compensation and incentive. When, which is patterns and timing. And how, which is one letter, a plan document list, and a real transition plan. The decision's yours to make either way. I just want you to make it on purpose with the numbers in front of you instead of making it by default for another 5 years. One last thing. Everything in this video, every document, every system, every vendor, every deadline, I put it into a broker transition checklist. It's free and it's in the description. And it's the thing I'd want in front of me if I were making this transition. For more content like this, subscribe on YouTube or check out benefitsblake.com.